there's two words that are almost never together in the tax code, and that is permanent exclusion. And so typically it's a deferral, or you have to do this to get into something else. If you hold an opportunity zone investment for the full 10 years, your cost basis steps fully up and all taxes are eliminated.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris. And our guest today is Michael O'Shea. He's the head of private wealth at Origin Investments. With over 18 years of experience, he's helped syndicate $10 billion in commercial real estate, including $500 million in 1031 exchanges. He holds an MBA from DePaul and the CFA charter. He now leads Origin's low-fee DST platform with a seamless 721 roll-up into a diversified income fund. He's data-driven, tech-savvy, and refreshingly transparent. Please help us in welcoming Michael O'Shea. Michael, how are you today?
Doing great. Good to see you guys.
Absolutely. Appreciate you being here. Thank you for making time for us this morning. I'm excited about this. I've done a couple 1031 exchanges. I've been looking at Delaware Statutory Trusts for a while now. I know you've got experience with qualified opportunity zones, which is something we've dabbled in with two of our deals. I don't have any experience with 721s. I understand you're doing roll-ups into a diversified income fund. I always tell people I'm looking for that situation where I feel like I'm the dumbest guy in the room, and boy, I feel like I found it today. So, Neil, thank you for joining me in that room. I appreciate it.
No.
So, Michael, please tell us a little bit about yourself, your background, and how you got into all this.
Yeah, happy to. And thanks for having me on. I'm looking forward to it as well. This has been a really powerful solution for folks over the last couple of years, and it's just growing because so many people are trying to get out from underneath the burden of managing real estate. So excited to get into it today. From a professional background, I've been doing this for about 18 years now. So primarily I've raised capital for different real estate syndications, whether it's private REITs, opportunistic drawdown funds. But most of my career has been on the tax-driven side. So 1031 exchanges, primarily through a DST, and believe it or not, even into a tenant in common back in the day before DSTs were really prevalent. And then with the advent of opportunity zone funds, remember that's part of the 2017 Tax Cuts and Jobs Act. So this is a relatively new legislation that had some kind of quirks to it that made it sort of difficult to understand. And it was good, not great. And we were waiting for legislation to get updated to become a permanent part of the tax code, which it did this year. And so now opportunity zones are permanent part of the tax code. So that's something that, I've worked in since the day they came out. And I think they're going to be, a bigger part of the investment, portfolio going forward. So I've got an MBA in real estate finance, got a CFA charter designation. And so this is really all I've done in my professional career. So I watch real estate closely. I watch the markets closely. And I think it's been a pretty interesting time these last couple of years. So lots to talk about there.
Yeah, what an interesting time to be in QOZs. The qualified opportunity zones is something that my perception of that is it was kind of a charter program that frankly seemed like it really worked. It drove a lot of money into these areas that really needed some gentrification and redevelopment. And some of the areas that are qualified opportunity zones were really surprising. There's areas of Myrtle Beach, South Carolina, which is right over the border from us, and like several nicer kind of resort area towns that are part of it. And the qualified opportunity zones are not these big chunky zones that I expected. It's a very fragmented map with a lot of opportunity out there. And it seems like it's something that, just like what you said, it was good, not great the first time, but seems to be something that's becoming a permanent fixture because it's driving revenue from these more expensive exits into areas that really need the development. One of the things that the perception to me was, this came out in 2017. Nobody really knew what it meant or what it did. And it's a 10-year hold. So still, no one has gone full cycle on this and won't for several more years. So let me ask you this. Is the burden more of like consumer education on educating them at least the first couple of years on what this is? What is this going to look like on the exit? And has that really picked up steam for you? Or like, how were those first few years dealing with qualified opportunity zones?
Yeah. Good question. A lot in there. I think 100% the burden is on education. A lot of times people would say, well, it's just a deferral. It's a 10-year hold. It's not that powerful. We've got the math to show how powerful it is. The thing about an opportunity zone is that there's two words that are almost never together in the tax code, and that is permanent exclusion. And so typically it's a deferral, or you have to do this to get into something else. If you hold an opportunity zone investment for the full 10 years, your cost basis steps fully up and all taxes are eliminated. And so it comes back to you liquid, tax-free, like Roth proceeds. I mean, it's really, really powerful stuff. And even CPAs weren't aware. Now, this gets into the minutiae, so I'll try to go through it quickly. But like the way the law was written, where I said it was good, not great, there was sort of this set date, 2026, December 31st of 2026. That's when you were going to realize your first capital gain in an OZ investment. And so if you invested back in 19, 20, 21, you had a long time to defer that original capital gain tax. Well, as we get closer to 2026, you only get to defer for 2 years, 1 year, et cetera. So that's where we were kind of getting to. And what we told the government is we need to have more of a rolling deferral, not a set date where like when you invest matters. And that's what they did. Not to get into it, but like Opportunity Zone 2.0, it starts in 2027, but now you'll get a 5-year rolling deferral. So I kind of say it like this to summarize. When you should have invested back in 2019, 2020, nobody knew what an OZ was. There was very, very few people that understood it. Now it's pretty well understood, but people say, well, I can only defer for 1 year. So it's really become sort of this dead zone that not a lot of activity is happening in OZs right now. But starting January 1st of 2027, the new permanent OZ 2.0 goes into effect, and you're going to have a rolling deferral going forward. So whenever you invest, you have 5 years to defer your capital gain. So that's why I say that I think it's going to really explode, because now people are aware of it, and it's very, very easy to invest. There's no qualified intermediary. Just, do you have a capital gain? If so, you could put it into an opportunity zone. So it's very conducive to investors just looking to allocate.
Great. Thank you. I'm going to ask one follow-up question. Now, I don't want to pigeonhole you to qualified opportunity zones. There's a lot of other things I would rather talk about, but let me ask one follow-up question. If you have an opportunity that has several people going into it, or a group of investors, some of them have capital gains, some of them do not. Could you utilize something like a TIC or a tenants in common for part of them to invest with capital gains and that qualify for the QOZ, or just is it a separate qualified opportunity zone fund for their portion? And then you would have the people that are investing with non-capital gains as a separate part of it? Or is there a way to split that up? How does that work?
So it's a little bit easier for, partnerships. People typically own things in a partnership. And I think you're maybe alluding to a 1031, where if people are coming out of a deal together, it gets really complicated really quickly. In an opportunity zone, it's totally different. So say you had 5 partners, each one got a K1, you had a capital gain, you had a capital gain. You choose what to do with your capital gain. So it's much easier from that perspective. So if you're talking about selling real estate, now remember, this applies to any capital gain. So you could sell NVIDIA stock, you could sell a private company. Any capital gain from any source, you can put into an opportunity zone fund. In fact, for real estate, most people choose the 1031, and we could talk about that. But where we're primarily seeing cash flows for the Opportunity Zone Fund is people wanting to unwind out of concentrated stock positions. The market's up 60% in the last 2 years. People want to take those gains off the table. The other one is having their liquidity event and sort of liquidating a private business. And you sort of go from asset rich and cash poor to the opposite. Now I'm an institutional investor. Where do institutional investors put their capital? Real estate is, a big part of it. So it allows you to kind of have that exit strategy, that liquidity event, and then roll, 10% of your portfolio into real estate in a very tax efficient manner. So it's very, very easy in an opportunity zone for complicated partnership structures to invest.
Nice. I'd love to start transitioning the conversation to involve the Delaware Statutory Trusts. And I know you also talk about a 721 roll up into a diversified income fund. Are we understanding that correctly, in that people can exit a deal and they've got capital gain and they can invest that, instead of investing it into a piece of real property, they could invest it into a Delaware Statutory Trust that immediately starts generating income, and it's getting them out of an active real estate investment into a more passive strategy that's generating income from them from day one? Are we assuming that correctly?
Yeah, you got it right. I mean, basically you say you exchange up into a higher quality institutional property, and then you exchange out of the day-to-day management. So when you hear Delaware Statutory Trusts, and people just wonder why that is, we've got a full revenue ruling from the IRS 2004-86 that says an interest in a Delaware Statutory Trust will qualify as real property for the purposes of an exchange. So kind of unpacking that, don't get overwhelmed by the DST, Delaware Statutory Trust. It's just a trust that owns a property. So let's just say it's a $100 million apartment building in Dallas, Texas. So you sell a self-storage facility, you sell raw land, you sell farm ground, you sell a condo, a single-family home, whatever you sell for $1 million. You would then do a normal 1031 exchange, meaning the money goes to a qualified intermediary. You have 45 days to identify a replacement property. And then at closing, you would actually buy an interest in this Delaware Statutory Trust. And you would have, if you follow the rules, you'd have a 100% full tax deferral. Now you own a 1% interest in a $100 million building, and you've gotten out from underneath the day-to-day management, and that cash flow is immediate, starts paying on a monthly basis.
All right. Let me ask a quick follow-up, because the one complaint I hear from some people when they hear Delaware Statutory Trust is that, they sound pretty easy to get into. How do you get out of it?
Yeah. So that maybe goes into our strategy and why we went with the 721 exchange. So typically in a Delaware Statutory Trust, maybe the model, back 10 years ago was sort of like you go into a DST. It could be an apartment building, it could be an Amazon warehouse, some institutional property, and you're going to own that for 5, 6, 7 years, and then it'll sell to a third party, which means you get cash back. It means you have to do another 1031 exchange. That's kind of known as swap until you drop. Okay, so during those 5 to 7 years that you hold it, it's illiquid. You can't sell it. Once it sells, you have 45 days. So you could either find your own replacement property or you could go back into another 1031 exchange, which works out well for a lot of people. The downside to that swap until you drop strategy, in our opinion, is that you have idiosyncratic risk. So just like you'd rather own a mutual fund than a single stock, when you do swap till you drop, it's single asset for single asset for single asset. It's a lot of eggs to have in one basket. The second part of it is it adds operational risk. So a lot of our investors have built their wealth and their ultimate goal is just preserve, protect my capital. And so like when you go into a swap until you drop, again, you have 45 days. And what's the market going to look like in 2032? Like maybe you don't like interest rates, maybe you don't like cash flows, but you have to go into something maybe begrudgingly because that's what's available during your 45-day window. So there's that operational risk. And then, of course, every time you roll into a new deal, there's fees, which can eat away at your wealth. And so the 721, we can maybe get into how it works, but essentially there's a lot of people. We have this great fund. It's called Income Plus Fund. We have a lot of cash investors that come in every single month, and it buys multifamily properties in high growth markets. It's a total return fund, so it's meant for growth and income. And it's highly diversified. It's got strong performance. And so a lot of people will call us and say, can I sell my property and do a 1031 exchange into your fund? Why would they want to do that? Well, they want diversification. They want the income. They don't want to manage the property anymore. And you can't because a fund interest is not like kind to real property. So there's sort of a two-stage solution that we do at Origin, where essentially you go into that DST, which does qualify as real property for 2 years. And then our flagship diversified fund, Income Plus Fund, has the right to acquire your interest in the DST after 2 years. So you could think about a timeline as doing a 1031 today. You're in that $100 million apartment building in Dallas. You get 24 distributions. You're in it for 24 months. You get any appreciation on it. If it goes up in value, you get to write it off on your Schedule E, just like normal. After 2 years, instead of getting a cash exit, you get an exit where we give you partnership interest in our fund. And that's where Section 721 of the tax code comes in. So because you haven't received cash, there's no need to do another 1031. It's considered an up-REIT. So like you're up-REITed now into our portfolio. And so now your risk is spread across all of these assets in the fund, and there's no need to continue to 1031 exchange ever again. You're kind of off that roller coaster. And I think just to kind of wrap this up, I think your initial question was about liquidity and like, how do I get out? And so what's nice about this is real estate is very much black and white. So like I either sell a building for $1 million or I don't sell it and I have $0. once you go into the operating partnership of the Income Plus Fund, or there's some other, companies out there doing this, once you're in that broader fund, there's quarterly redemptions. So if you have $1 million interest, you can make a redemption for 100,000 or 200,000. Of course, that's going to be taxable for you, but it allows you to, request that redemption and get some cash out. So it turns this completely illiquid asset into a partially liquid asset.
So, and you mentioned fees. I think now is a good time to mention that my understanding is that not all Delaware statutory trusts are created equal. And the way that you guys do things and structure things is a little bit different. A lot of times you hear people say, oh, well, Delaware statutory trust fees are brutal. So I know that you guys specifically strip out some fees. Some are going to be unavoidable. But what does $1 million look like in a typical broker Delaware statutory trust that's compounding versus somebody that's investing with you guys over a period of time?
Yeah, that's a good question. I think, first of all, I will say that DSTs are getting better. They were very, very high fee, where if you read through the PPM, sometimes they make you squirm. And the problem is a lot of their investors, they just don't read it. They have $1 million investment. They see $1 million in a DST, but they may be totally unaware that they've just bought 800,000 of real estate and 20% is gone in fees and commissions and other, types of fees. So I will say across the board, that's generally coming down as people are becoming more aware of Delaware statutory trusts, et cetera. Origin was out of the DST business. I actually came to Origin to architect the entire platform. I kind of wrote a business plan to the founders, and I said, I think we should add this as an offering. And their initial pushback was, that's just not what we do. We don't do high fee products. And so I said, well, what if we just created one where we kind of stripped out all of the fees and we did the 721 into our broader REIT, and that's really what made sense. So when we put our deals together, at least at Origin, we don't distribute through the broker dealer network. We work directly with investors, and we work directly with some fee-only financial advisors who will charge an asset management fee for investing on your behalf. But there's no selling commissions or anything that, come out. So what I've found in my career is that when I was doing these, deals years ago where there was a commission in it, I would basically sit there with the end investor and kind of explain everything. And that end investor would kind of know more than, the broker. Like they had been doing real estate for 20 or 30 years. And so it was just kind of clicked in my head, like, what do we need this intermediary for? If you're very knowledgeable on real estate, you can sort of make decisions. And so that's it. And so for at Origin, it's right on our website. We've got all of our fees right on the front page. You can kind of see that 97 cents of every dollar is going to work when you invest in one of our DSTs. And that's the concept. It's a low fee DST. And we think all things being equal, you're going to have a better overall return by investing in a lower fee product structure than if you paid those, commissions and other fees up front.
So obviously, it sounds like it's pretty heavily invested in multifamily. Multifamily has pretty much gotten kicked in the teeth the last 2 or 3 years. And I've heard you say that Origin uses machine learning to choose markets and timing. For a lay investor, what does that look like, and how did it change your decisions in 2023 and 2024?
Yeah, there's a lot to unpack there. So Origin, which we didn't really get into, is founded as a family office to invest the capital of our two co-founders. They were derivatives traders in Chicago and did obviously quite well. And they built Origin by basically saying, hey, we've built this wealth. What asset class can we put our money into now for the very long term in a tax efficient way that's going to preserve and protect our wealth? And they chose real estate. You got to think about it. These were good investors, but they were not real estate guys. And so when they started looking at the data from these different data sources that most real estate companies rely on, it was not accurate in predicting rent. And so it's a little bit about our DNA at Origin that we just find a way. It's one of our core values. And so they hired a data science team before generative AI was really a thing. This was probably 2018, 2019, and basically said, we need to do a regression analysis to find out what KPIs are leading to net operating income growth in certain markets. And then let's find those markets that have those KPIs, right? But it was a lot more sophisticated. So Multilytics is what they built. It takes in over 9 billion data points every month now. And a funny story about that is I think our first launch was January of 2021. So we always put our predictions out there in the market, and then we sort of update how we're doing. And it had predicted, for example, Gilbert, Arizona to go up in rent 43%. And it had predicted Seattle to go up in rent 15%. And so they thought it was broken. By the end of the year, Gilbert, Arizona went up in rent 42%. And so they're like, man, we're really onto something with this. So its predictive capability is off the charts. It's over 95% accurate in predicting chunk rents in certain markets. What's interesting about Multilytics is that it doesn't just say like Phoenix is going to do this or Dallas. It breaks the United States down into 100-yard by 100-yard squares. So we might have a low Multilytics score here, and then a quarter mile away, we've got a higher Multilytics score. We don't base everything on that. Real estate is about people, just like any other business. And so Multilytics sort of gives us a guide. It helped us call certain cities early. Jacksonville, Florida, Colorado Springs. We're one of the largest developers in Colorado Springs, for example. So it sort of points us to the right markets of where we want to be, where we think demand is going to outpace supply. And then on the other side, 2023, we were the only real estate company we're aware of that was calling for rents to decline in 23. And remember, in the last 100 years, across the United States, multifamily rents have dropped 4 times. So 2023, nobody expected that because they had been going up so significantly the last few years. And we saw it. We saw the oversupply and we saw what was happening. And so we really pulled back and changed our investment parameters. We stopped when cap rates were in the 3s and interest rates were at 0. We just stopped buying properties. We didn't want to be common equity holders. And so we switched to more preferred equity positions. We switched to ground up development. And that's really protected the portfolio. And we've done quite well. Like it's sometimes when I'm talking to investors, they say, well, what if there was a stress test? Like, how would your portfolio do? And they don't realize that we've just gone through it because our returns have been positive. So if you look at like the NCREIF Odyssey Index, for example, in 2023, that index was down 12.5%. We were up 4%. That's a 16-point delta because we chose to stop buying common equity and invest elsewhere. So like we still like real estate. You just have to be somewhere else in the capital stack. And so I think that's what you get with Origin. And so like from peak to trough, we're down almost 30% in multifamily valuations. There's a lot of reasons why we think there's significant tailwinds behind us. Multilytics for our markets is predicting between 5 to 7% rent growth annually for the next 5 years. So we think we're going to see pretty significant rent growth. And the best time to invest is the day after a recession, right? And it doesn't feel like it because the market's been going up so much, but we really have called the bottom and think we're out of this recession in multifamily real estate.
Yeah, we're seeing the same thing. We operate in self-storage and we just feel like we have just got the data that is very clearly showing that whether or not anybody wanted to admit it, we're coming out of a 2 to 3 year recession, specifically in self-storage. And, metaphorically and physically, spring is coming and we're all excited about that. I want to circle back on the resounding thing that is jumping out at me that is so cool about what you guys are doing is the 1031 into the Delaware Statutory Trust and then the 721 exchange into the income fund or the income plus fund. Who is that best for? What's that avatar? Who is that investor? What does that guy look like? What's his story about the properties that he's currently invested in and the average guy that discovers you and is rolling into your investment? What does his story typically look like and who should be paying attention to this?
Yeah, I think it's bifurcated a bit. I would say our number one is accidental landlords. People that it's so common that you have two condos and then you kind of move in with your spouse and then you rent out the other one, but that was 30 years ago. Then you bought a couple other in the buildings. Now they've tripled in value. So now you have a $4 or $5 million portfolio. It's like, oh, you must be a good real estate investor. Well, I just own a couple of these condos that have gone up in value. It's just been a long time. And so what happens in real estate is, unlike other asset classes, like owning a portfolio of ETFs, there's actual work to do. And depending on the state that you're in, California specifically, there's different propositions that are making it more and more difficult and more expensive for you to keep up with all the regulations. So a couple things happen. Number one, I'm tired. I've built my wealth. I'm tired of managing this. I'm tired of getting phone calls. I'm tired of the tenants not paying rent and having to deal with that. Am I charging enough rent? All the things that come along with managing any business. And so that is kind of our primary customer out there, where I kind of go back to this exchange up and exchange out. You want to simplify your life and protect your wealth. The second part of it is like, who's going to take this over? You sort of get a PhD in real estate by going through it. Like, oh, our taxes are too high. How do I appeal that? Okay, now I've got that figured out. Now I have an attorney that does that. So like you learn all this, you have all these connections, you know people that can fix stuff. Then do you want to give it to your children? Maybe they don't geographically live near it. So you worry about it going to your estate and causing problems because it's illiquid. So this really cleans up your estate. So if you think about, you've got, a $4 million real estate portfolio and you've got 4 kids, this would now be a $4 million interest in a $1 billion portfolio of real estate. And when you pass away, each of your kids would get a 25% interest with a fully stepped up cost basis. So they wouldn't have to have any burden of management. If they needed the cash, they could sell it tax free. If they didn't need the cash, they could just reinvest the dividend and let it grow for their retirement. So if you think about what the extremely wealthy families do, is they put real estate into dynasty trusts for their grandchildren's grandchildren. The reason that most people can't do that is because who is going to manage this when I'm gone? So this is sort of a solution that allows you to do that as well. So that's our primary customer, I would say, and several others there, but that's probably 75% of who we work with.
Not factoring in all of the tax savings, which obviously is the 800-pound gorilla in the room when it comes to this. But what does it look like from a return profile once people are rolling into the debt fund? If somebody has $100,000 in there, what does that look like for them in terms of the Are they able to choose monthly, quarterly, or compounding, or how does that work?
Sure, good question. So we do have a debt fund, but that's not what you'd be rolling into. The Income Plus Fund is more of an equity fund. It's our all-weather fund. So we do ground-up development, we do core plus, like all in one fund. The goal of that fund you could sort of think of as a 9 to 11% target range, where call it a 6% dividend and 4% growth on an annual basis gets you to about a 10% annualized rate of return. That's exactly what we've averaged. Our 5-year trailing return is 10.0%. So we're sort of right there, including going through this pretty monumental real estate recession over the last couple of years. So we think we'll outperform that going forward. And then in terms of compounding, that's extremely powerful. One of the things we talk about when the market is going up so much, if the market goes up 20%, then up another 20%, and you're through the roof, all it takes is for it to go down 20% that third year, where you would have done better earning 10% a year each year, just staying positive. So the idea of staying invested in something and compounding, we pay on a monthly basis. So if you're reinvesting the dividend, you're compounding that 12 times a year. And there's something in finance called the rule of 72. So you take your annualized return, you divide it into 72, and that's how long it takes something to double. So if we're generating a 10% return, you'll double your investment every 7.2 years. So $1 million investment in 7 years is worth $2 million. 14 years, it's worth $4 million. So if you're 14 years away from retirement, you could turn that $1 million asset into a $4 million investment by reinvesting the dividend. Then you could turn on the distribution on a monthly basis, and that would start generating 6%, $240,000 of income for you. So it's a really powerful way to build up that asset base and compound.
Love that.
So walk us through the timeline and logistics that you recommend for people, from the QI setup, identification strategy, the matching the debt and the equity to avoid the sort of classic ways that people, blow a 1031.
Yeah, all great questions. So obviously this is where we spend the preponderance of our times, actual cases. I'm selling at this debt. So we can walk you through all of that. Our DSTs typically have leverage on them. They won't always, but right now they do. They're about 50% levered. So if we buy a $100 million apartment in Dallas, it's got a $50 million first mortgage, and then we raise $50 million of equity. So when you invest in that deal, you assume that debt as well. The nice thing about it is that debt, while you get credit for it, for the fair market value for replacement property, it never hits your balance sheet. There's no recourse to you as the investor for that mortgage. It also gives you additional cost basis. So if you're selling a building with zero basis and you roll $1 million, you've now assumed $1 million of new debt, which gives you $1 million of new basis, which allows you to offset your income going forward. So that's one of the first questions I ask is, do you have a mortgage on the property you're selling? If the property you're selling has a loan to value 50% or less, 50 or less, then you could roll directly into our deal, assume our debt. That would replace your debt, and you would have no taxes due. And that's really powerful. So a lot of people think they pay off the mortgage. Now I'm going into an all cash DST. You have to add cash. So the fact that we've got this debt now for people that are 55, 60, 70% LTV, that we wouldn't replace the full debt. So you'd have to add some cash in those cases or pay a small amount of taxes. But we can walk through that like on a case by case basis. The other part of it is pretty simple. So real estate is extremely complicated and selling a deal and then closing another one. If you think about a DST, it's like a real estate closing in reverse. We've already bought this property. We financed it. We closed on it. Everything's done. So all you have to do, and I've done this before. Let's say you've got a closing December 1st. Okay. So you have to get a qualified intermediary. We can send you some referrals. They're easy to find online. The money has to go to a qualified intermediary in a 1031. If you ever take the possession of the proceeds, you've kind of blown the exchange. So you kind of get that set up ahead of time. You can actually fill out our paperwork. Like we've got a DST in Nashville. We've got a DST in Charlotte. You say, hey, I like the Charlotte deal. Great. So you fill out all the paperwork. Say, I'm going to put $1 million in the Charlotte DST. It takes us a few days to verify you as an investor. Now you're in. We're just waiting for the funding. You got the QI set up. So December 1st, you close on the sale of your property. The proceeds from that sale go directly to your qualified intermediary. And December 2nd, we call the QI for funding. So you could sell your property December 1st. You could be in our deal like December 3rd or 4th. And then you would get a distribution in January. So it's really pretty quick because it is a security and everything's sort of wrapped up in turnkey.
It sounds like a lot of what you do is hand-holding and consultation. Like you guys, these are veteran moves. You guys are in it and you're in it pretty deep here. These are veteran moves, and a lot of what you're going to do is going to require consumer education, I'm assuming. So I'm sure that's a big part of your job, which is probably why you're really good at explaining this stuff. Do you guys also offer any kind of consultation for groups that are trying to utilize Delaware Statutory Trusts or 721 or anything like that?
Yeah, of course. Like my whole job is explaining things, and we have over 4,000 individual investors at Origin, and we've got a full investor services team as well as an investor relations team that kind of walks you through everything. And obviously, we have 10 to 20 investor groups across the country that we work with. We also educate, CPAs, estate planning attorneys, people that are on the sort of like the transactional side, commercial real estate brokers. I'll speak at CCIM events, that type of thing. So education is the number one thing. The most common feedback I hear is, man, I wish I heard about this a year ago because I just paid taxes. I didn't know this was an option.
Yep. This will probably be last question for me. What are the speaking events that you have coming up this year that you're excited about where we may be able to connect with you?
I've got one this afternoon. So
be right there.
Yeah. We work with a lot of apartment owners associations, right? So like that's just, these really, it's funny when I'm at the apartment owners associations conferences, people come up to our booth and say, what do you guys do? Like, cause most of what you see is HVAC and gutters and like all the problems that come with real estate. So I point down the booth and I say, you see all these booths that are helping you fix problems? We eliminate all of your problems. The whole thing is like real estate problems don't go away. It's just that we wake up every day and deal with those problems as a professional real estate manager. So you're just outsourcing those problems directly to us.
I love that.
Stealing that line.
Yeah, that was solid.
Yeah. All right. I think this is my last question. What are the minimums like? Oftentimes, DSTs are often very expensive and complicated to set up. And sometimes that means it comes with pretty higher minimums than the standards syndication. What are the minimums?
Sure. So we have a stated minimum on our 1031 of $250,000. That's because I want people to know it's a very long-term investment. It generates a K1. And so we've had people come to us with less and say like, can I get in? It's just, or I've got leftover. I sold a building for, $2 million and I found something for, 1.9. So can I roll this 100,000 to you? It's like, we always allow that kind of thing. The stated minimum is 250, just so people know that it's sort of a long-term illiquid investment. On the Opportunity Zone Fund, our minimum is 50,000. A lot of times people will get a capital gain distribution in a mutual fund. So what the heck do I do with this, right? So you could throw that into an Opportunity Zone Fund. Kind of same thing on the Income Plus Fund. That's a $50,000 minimum as well.
Awesome. Great.
Sure.
Well, Michael, I'll ask our last question here. We used to just ask people what your favorite book is, but the reality is there's a more interesting way to ask this question. With everything that you're doing, as much as you're teaching people, I'm sure there's a lot that they want to continue to educate themselves on. Do you find yourself recommending one book, resource, or podcast or something like that more than anything else to people that are really trying to learn more about what you're up to?
Yeah, that's a good one. Like the thing for me is like I know so much about this that I tend to not read about real estate taxes and things like that. I read books about improving your business. A book that's really made an impact on me is Traction, which is the entrepreneurial operating system, EOS. And, it sounds like you guys have enjoyed that book as well. I think I've heard similar things from business leaders out there, and we're all kind of working our way to be better at what we do, whether it's a father or business person or what have you. And so, what resonated with me about Traction, I've actually mailed it to a couple people, is everybody says the same thing. There's just so much noise. I sat at my desk from 8 to 6 and I feel like I didn't get anything done today. So what Traction does, it makes you take a really hard look at your business and say like, is this important? Is this important? And it whittles it down to about 6 things. And you have a weekly check-in on those 6 things to see if your business is moving in the right direction. I always like that, keep it simple, stupid kind of thing. You can kind of overthink this and all that. We're also kind of looking heavily into AI. Like, I just don't think this is going away. So I have a book on my desk here. Jeb Blunt has written a lot of books. This one is called The AI Edge, which I haven't cracked yet, but I'm excited to get into it and see kind of like what that next iteration of, customer service and business efficiency can be with AI, because I think it's obviously here to stay.
Yeah. Just to follow up on that. Yeah. We work on EOS as well. Love it. Absolutely has been a complete game changer in our business. And I'm sort of deep in the weeds with AI. I've been sort of an early adopter, but even I feel overwhelmed. It's changing so fast. This morning, I woke up to a bunch of videos from Adobe's, the Adobe Max conference. Adobe is the one who produces Photoshop and Illustrator and Premiere. And they showed some tools that are just blowing my mind. It's just like every day I wake up to some new tool, some new use case. And what I find myself, I have to work against this is I get paralyzed by just the amount of stuff that, is coming through. It's incredible.
Yeah, the noise is not going to stop, right?
It's not.
It's going to pick up, and there's going to become more of it, which is why I'm so glad you brought up Traction. Gino Wickman, we give that book to every new hire that we have. We operate off the entrepreneurial operating system. We just got done discussing our quarterly rocks yesterday, and we have level 10 meetings every week. It is the way to go for anybody curious about that. But the reality is AI is not going to stop. Technology is not going to stop. The speed is going to continue to pick up. There's good and bad with that, right? We have more opportunity now than we ever have had in the history of the planet. We also have more distraction and noise than we ever have in the history of the planet. And because of that, I think the meaning and purpose behind human connection and interactions is actually going to go up in value, because I think so much is going to become cheaper and you're getting bombarded with so much noise from everyone competing for your attention that I'm hopeful that personal connections and investing with people or building relationships and bonds for the long term with people that like, and trust is something that becomes more important than just targeted marketing, which is what it feels like the world is right now. So.
I tend to be a real optimist there, because if things are becoming more efficient and we're spending less time in administrative tasks, then we do have more time to kind of make personal connections with people. Somebody I have friends with a tech guy out in San Francisco, and I said, man, is AI going to take all of our jobs? Like, cause he's pretty heavy into it. And he was like, well, think about this. And it was a really good analogy that I had not thought of. He said, remember, people used to do private equity deals back in the 70s and 80s with graphing paper and a calculator. And they would have to write everything out, and they'd write all these tables and keep it in a file folder. He says, and then Microsoft Excel came out. And so not only could you do 10 hours of work in a half hour, but you could also share it with people, and it would fix your errors and all that type of stuff. And he goes, do you think the amount of deal volume picked up or slowed down? Do you think the amount of people hired in private equity was more or less? And it's just such an obvious answer. So I think it's just going to make our rather opaque markets just more transparent. There's going to be more people working in the real estate space. There's going to be more available data to everybody. And I think our administrative tasks will go down and our personal connections will go up. That's what I'm hopeful for.
I hope you're right.
Yep.
Look forward to watching it together. Well, Michael O'Shea, head of private wealth at Origin Investments. Thank you so much for your time today. I've really enjoyed this. Thank you for letting me ask a lot of selfish questions and record it so I can go back and listen to it again, which I'm going to do multiple times. I have no doubt. If any of our investors or listeners want to find out more about you, about Origin Investments, what you guys are up to, or look to connect with you, what would be the best way for them to do that?
Yeah, we are all over the web. We do a lot of content generation. So if you visit origininvestments.com, you can kind of find out everything about us. And if you want to email me directly, I'm just M. O'Shea. So first letter and last name, MOSHEA at origininvestments.com. Be happy to chat.
That's great. All right. Well, thank you, Mike. We really appreciate your time today. Thanks for stopping by.
Yeah, this has been great.
Thank you, guys. Appreciate it.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode, leave a comment down below, or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.